Hello, everybody. My name is Adeo. I'm CEO of VC Lab and Decile Group. Decile Group is actually the parent company of VC Lab. And I'm here to talk to you today about the venture recovery. And the interesting thing is VC Lab, Decile Capital, which is our fund of funds, Decile Hub, which is our back office SaaS software, and Decile Partners, which powers a lot of venture capital firms worldwide, collects just an enormous amount of data on the venture capital industry, okay? To put things into perspective, last year alone, we launched about 175 firms in market. PitchBook reports that there's roughly worldwide 393, just under 400 firms were created last year worldwide. So to give you a sense of scale, the 175 firms that we accelerated last year is a big chunk of all the firms that were created last year worldwide. And, you know, because we have the accelerator and we see everything that's going on with them in the accelerator, because we have tools and we see all the metadata from the tools, because we're doing formations and back office, so we see all the deals being done, all the limited partner agreements being signed, all that. And then we have Decile Capital, and we're actually investing ourselves. We made our 7th investment into a fund just last week. Actually, technically, we consummated it this week, but we made the decision last week. You know, I don't see a slowdown. Okay, I think venture capital's in full recovery. So I'm going to be talking with you about that right now. And let me share the screen and get going with a presentation. So remember, introductions in the chat, questions in the Q&A. So venture recovery 2023. Hard to believe that's actually happening, because if you read stuff in the media, you would think the sky is falling and we're all about to die if we exist in venture capital. So for example, I just pulled some headlines. Sheer panic has gripped Silicon Valley VCs and founders amid worries that the startup industry's bank is in trouble. Okay, so kind of the crazy panic surrounding venture capital started with the chaos that I mean, it obviously started with a lot of things, but it certainly was culminating with the chaos around Silicon Valley Bank, which ironically was brought down by venture capitalists talking about how bad things were, and then they instilled panic in all of the bankers at Silicon Valley Bank, who all fled, and then the bank collapsed. So of course venture capitalists brought this upon themselves. But this is just a great headline. Another favorite one: VCs face an existential threat because there are too many of them. I've never actually heard of like too many of something causing those things to go away. Usually it's the opposite, right? So you have an existential threat when your numbers are dwindling, not when your numbers are increasing. So even the headline is like just tautologically, logically wrong. It's like, huh? Like, aren't more VCs not an existential threat? And actually this particular article, I loved, because it was VCs complaining that there's too much competition, and somehow that becomes an article. Venture capital funding plummets globally in first half despite AI frenzy. Again, like oxymoronical headline, like there's a frenzy of investing in AI and yet overall investing plummets. And these headlines, and this one is, I can explain them all, but I'll just talk about this one for 1 second. There definitely has been a decline in these mega rounds, right? The few $100 million rounds by Tiger Global and SoftBank, which were insane to begin with. So obviously, if you have like, and there are charts that, and I didn't put one in because they're kind of ridiculous, but yeah, in 2022, people were writing crazy amounts of money in the later stage.
and in like insane amounts of money. Okay. And so that stopped. That should have stopped. That should have never happened. Right. So that was already an outlier. So so basically, if I were to like put the sane person's hat on and write this like a reporter versus a clickbait headline, I would say something to the effect of the mega rounds have declined, and AI is the new, whatever hot industry, right? But that obviously doesn't get clicks. It has to be venture capital funding in free fall, like, or plunges, right? And so all these headlines, all the news that you're reading, in my humble opinion, from data that I actually have, are just bull. Okay, you can really ignore it. And sadly, because I wish there were a reliable source of data about the venture capital industry out there that wasn't sensationalizing things, publishing things that are wrong, taking like data and trying to make conclusions on it, which are not accurate. So unfortunately, we are in a world where most of the stuff you read on the internet about venture is just plain turd. Bull. Okay. And I hate to do this, but I think a lot of the craziness that we're facing right now, not just in venture capital, but also in the world, is just a direct result of COVID, right? So during COVID, people were kind of staying at home, right? And if you stay at home, you don't spend money. If you don't spend money, you can invest in lots of things. So crypto went crazy, venture went crazy, money was flowing everywhere because people had lots of extra money because they weren't doing anything. Right. And now COVID's over. All right. At least the pandemic's over. And so, and not to demean it, and I think it may be even too soon to talk about this subject. We certainly, COVID was hard on humanity, right? Great for the environment, hard on humanity. Now that this is the first summer that it's just not a pandemic anymore, not even an epidemic anymore. It's just not in the global conscious at all. You don't see people wearing masks on planes, nothing like this. So people are out and about and stuff is just weird, right? Your markets are weird, venture is weird. I really don't think looking into the summer of 2023 and drawing like great conclusions about the venture market or the crypto market or the bond market or any market is sensible, because we're in this weird recovery period, which I'm guessing is going to continue for at least a few more months and possibly another year. And so here's what I do know, okay? When you look at venture capital today, you can sort of segment the world: early stage, growth stage, late stage, private equity. And then you can say, hey, what's doing well and what's doing badly? And mega funds, just across the board, are not doing well. Okay. If you're out there raising like a few $100 million, like 500 million to over $1 billion, you are struggling. Okay. It is not a good world for you. And you can see this with Tiger Global and everyone in that range. Sequoia returned money, okay? And then they said, we're not going to charge fees on other money. So they're like, these big funds all realize that big funds are not the best idea. They're impossible to raise. So mega funds are in trouble, right? Late stage and private equity, they're also in trouble, right? Because these companies got so big with these mega rounds, right, that they're all trying to, oh my God, I have this company that 9 months ago was worth $7 billion. There's no chance of them going public. There's no chance of another investor coming in at $7 billion. So what they're all doing, and this has happened before many times in history. It happened in the late 90s. It happened again in 2008, 2009. So this is, it happens. They're all like in
holy crap mode, trying to save portfolio companies and things like that. So that they're it's not even that they aren't investing. They are investing a little bit here and there, but they're really in like, oh my God, I have a lot of portfolio problems. I have to clean up my portfolio. I have to fix this. I have to get this company funded. This company needs to wind down. So they're definitely in trouble. Okay. So your late stage, your private equity people, for the most part, are also in trouble. But when you go to like early and growth stage, so that means pretty much pre-seed through, let's call it like Series A, Series B, things are fine. And I would even say that we're in full recovery. And in fact, if you go to the micro early stage, 100% full recovery. It's definitely like micro early stage is 100%. And as you move kind of diagonally out, it's a little less, but I'll show data. You can judge for yourself. So the first thing that I'll share that we see is that we track the number of commitments in our, we have a back office platform used by 500, over 500, I think it's 520 something, 520 something venture capital firms use this platform every month, okay? And in September of 2022, we had a pretty good month. It was actually our best month in history. And then just things went haywire, right? And you can see exactly what happened here. So we got down to like below 20 million a month in December of 2022, which to us is the nadir, the low point in venture capital, December 2022. But then it started eking back up, and June of 2023 is now our largest month in history on the software, with limited partners committing $53.4 million, largely to new and emerging managers, just on our little platform, right? So obviously our platform is a microcosm of the larger world. And we focus on emerging managers, and we, as I say, we have 500 something emerging managers using it. So it's a representative sample, and the recovery is underway. And there's a second interesting point about this. I'll go into this more later, that June isn't really a great fundraising month, everybody. There's something called the summer slowdown. I don't see a summer slowdown happening in this chart. Now, July will be a little less than June, but July is also very high right now. So we're seeing really unusual trends across the board. I'll give you some other data though, because I want to give you lots of data. If you look at the 6 months ending in June, right? There were 37 first closings, new first closings in that 12-month period. Looking then at June of 2023, it was 61. So we had a 64% increase in the number of firms that completed a first closing. Okay, well, maybe we're growing, maybe that's it. Okay, so now let's look at a first closing, okay? Those closings did 175 million, average fund size going to 204 million. So that was a 16.7% increase. So you're increasing the amount of money that's coming in as well. So more closings, more money per those funds. So maybe there's other issues, right? Maybe not enough people, like maybe people don't want to enter venture. Okay, well, let's look at the people who want to enter venture. Let's look at the applicants to our cohorts. So again, same time period ending in June last year, we had 6,318 people start applications to our programs. This year, we had 9,329. So that's a 47% increase. So again, like, find me some bad news, anyone. I'm not seeing it, right? So let's just let's look at individual cohorts. So cohort X just graduated.
like, I think was it last week, Niels, or the week before?
The week before.
The week before, 2 weeks ago. Okay. We had, I believe it was 62 firms. So it's the largest number of firms in history completed the program. And they had the largest number of commitments at the end of the program from limited partners. So they had the not only the largest number of firms, the largest number of commitments, and on every way you slice that. So the most average commitments per firm, the highest number of commitments, just all across the board. Limited partners were committing to cohort 10 at a pace. Well, maybe that was an anomaly. So let's look at cohort 11. Cohort 11 is our strongest cohort to date. It's actually smaller than cohort 10 by a little bit, 10% smaller in terms of the enrolled, but it has the most amount of money committed by limited partners at the 6-week mark in the program in history. It's kind of stunning. We're like, whoa, there's a lot of money coming into these firms right now for this early in the program. You know, it's so again, we're just not seeing, we read this stuff in the media, like you read it in the media. And then we look at our data and we're like, well, where is, you know, where's the bad news? I don't see. I mean, look, I could make bad news up. Then I'd be like every reporter, but at least when I look at what we're doing, the numbers, the progress, we don't see it. So, and then like traditionally there's a summer slowdown, right? Where like people stop investing in funds and venture capitalists stop investing in June and July. I'm not seeing that either, right? So if you think about that, like what's like, again, June had the most amount of LP commitments in our history, and June is traditionally a slower month, and July is a dead month, and August is also a dead month. And July is looking, we're going to triple the amounts of commitments year over year from July to July, and maybe more, maybe quadruple, right? In terms of the system that is tracking commitments from LPs. So again, we're not even seeing a summer slowdown. So this is a weird one for me. And this leads me to believe that there's something going on with the COVID recovery, right? Because travel is through the roof. People are going everywhere and anywhere, right? And they're also continuing to invest at an incredibly high pace when traditionally this is a very slow time of year. Which leads me to believe that the global economic engine has like turned back on and it's behaving differently than it would normally do, either because it's starting up or it's changed, right? But because this is the first summer where really COVID is not really endemic, not really a pandemic, not in the consciousness of people, for at least the time being until we see this data next year, I'm of the conclusion this is a starting up phenomenon, but we shall see. But again, we're not seeing traditional summer doldrums, right? And that's very unusual. So what I would say is, you know, we're in this very interesting time in the world where, you know, it's just weird. Right? It's like I've never seen anything like it. Like you literally have the media, you have pundits espousing how bad things are, how much trouble everything's in. And then if you actually look at the underlying data, at least the data that we have, and the data that we have is substantial, right? It is a substantial portion of the data of the entire industry. It's not showing this at all. It's in fact, it's showing the opposite. And so don't look a gift horse in the mouth, okay? We've got like one of the best times in history to invest, right? And to be a venture capitalist. And let me talk about that briefly, okay? Without stupid slides with a horse on them. So we've got
right now, all right, valuations have come down, all right? That is a phenomenal time to invest, right? Because valuations are down, right? When valuations are up, it's not necessarily a bad time to invest, but when a valuation is really high and you get another round, that round has got to be really, really high to get the markups. And right now, with the valuations lower, they're going to eventually go back up because they've gone down, right? It's a phenomenal time to invest. In fact, most venture capitalists that are experienced and have been through a couple downturns will say they think that 2023 is the single best vintage year in history. Okay, so let's start there. Next, you have crazy talent entering the market because a lot of big companies, Apple, Google, are like, you got to come back. You got butts and seats. I just built this massive plant for whatever, $1 billion, and it's not going to sit empty. So you're coming back. And a lot of employees are like, I'm not coming back. I don't want to come. I didn't like working at the company that much before. And I certainly don't want to spend an hour or two commuting a day or more. So I'm out. So you have a massive talent pool entering the market right now. Top people from Google, top people from Apple, top people from Meta, top people from Amazon are departing every day, joining startups to do AI, joining startups to do all sorts of different things, healthcare, etc., which leads to another important area. Okay, so you got declining valuations, you got an increased talent pool, and we have probably one of the most significant industries that's come into shape in the last 4 months in the history of industries, and that's AI. AI will touch every single business in the world in a meaningful way within the next 12 months. And the players that become the billion-dollar players in that market are being set right now. And what can be done is just incredible. So there's a massive technology shift while these other things are happening, lower valuations, more talent, and a massive technology shift, similar to the mobile phone, similar to the internet itself. The impact is going to be enormous, right? Computer vision, medical, fintech, everything's going to change. So you have massive innovation as well, right? So on terms of the money, so that's a mixed bag. Okay, so we're seeing money coming into the early stage, the mid stage funds, the smaller funds. So your money is still flowing into venture capital. Where you are seeing some issues is that these big institutional sources of capital, right? The sovereign wealth funds, the pension funds, the endowments, the large corporates, and et cetera, they are over allocated into venture capital. And so they're not putting as much money because venture capital actually has been performing well compared to all the other things they're invested in. And so as a result, these mega checks are not coming into the asset class. But again, that doesn't really affect early stage, mid stage funds because they don't rely on $100 million checks. They can get a $5 million check. They can get a $10 million check, and then it'd be like great for them. They don't need a $100 million check. They don't need a $50 million check. So really the absence of those larger LPs really only affects larger funds and later stage funds. And so that's it. And frankly, I'm telling you this, as ventures in the earlier stages shows that it's kicking ass and the media finally catches up because they seem to be reporting on things that happened months ago with these stories, that once the media catches up, the excitement builds, the LPs will start writing checks again, and the later stage coffers will be refilled, and
they'll clean out all the mess, and they'll start backing the companies that the early stage investors are funding right now. And we're going to have probably the one of the best recoveries in venture ever, because every single industry everywhere in the world is about to go through a pretty dramatic shift just from AI, and and that's not even factoring in many of the other innovations that are happening right now. So, net, I'm very bullish. But what I want to do is start talking through your questions and make this more of a dialogue. So again, if you can do me a favor, go in, ask your questions into the Q&A. If there's a question in there that you like, there's a thumbs up, upvote it. And what always happens in these things is I'll go through 3 or 4 questions, and then people will start adding questions, and then we'll get to the end and there'll be like 50 questions. When we start, there's only like 5. So do me a favor, if there's something that you want to ask, try and get the question in now so we can have enough time to get through them all. Okay, there's a question from Addy, and usually I can get the first one, Niels, and then you can ask, and I'll grab a sip of water, whatever. And Addy's asking, can you share your views about microfunds launch outside the US versus US-based funds? Yeah, so usually microfunds, just definitionally, everybody is like 10 million or less. And almost every new manager should start with a microfund. Sequoia started with a $3 million fund. 500 startups started with a $5 million fund. The single largest performing fund in history, which was lowercase capital 1, he shot for 10 million and couldn't even get to 8, closed at 7, and I think he had a 241x on the fund. So micro funds are, it's a term that defines 10 million or less, but it really is the fund size of all new managers, right? I mean, Sequoia started with a $3 million fund, all right? So the difference between the US and the rest of the world is that's a very, I wouldn't look at it that way, actually. So first thing I would say is that's the wrong categorization. The way you have to categorize this is developing and developed markets. So in developed markets, your upper end of a new manager fund should be around 10 million, unless you're a really kick-ass human being, and then maybe you can get it to 20 or 25, but you have to be really exceptional. And that will take you about 24 months to raise from your first close. Now, if you bring your fund size down, you just cut your fundraising time down. In the developing world, I would just say it's to go above 5 million, you really have to have a lot of great connections, et cetera. And again, even at 5 million, that will take you about 24 months to raise, and lots and lots of meetings. So the other thing to look at is you might need 200 to 300 LP targets to close a fund in the developed world, and you might need 400 to 600 targets to close in a fund in the developing world. So the criteria here is total fund size, bit larger in the developed world, and then time roughly the same because of fund size, but your number of pitches will be 2 to 3 times more in the developing world. Okay, let's keep going. How many of the 175 firms successfully closed from that's a good question. I don't have that exact number off the top. It's 174. I can I was going to put this in there. So we're seeing, and maybe I can share my screen here. So we're seeing roughly
cohorts 1 to 3, the average time to first close was 12.4 months. Cohorts 4 to 6, so this is sequential over time. The average was 9.7 months, and then cohorts 7 to 9, the average was 6.3 months. So what you're seeing here is that as time moved on, it's become much faster, and that's another data point supporting that things are getting better because it's easier to close and faster to close. So the 175 firms in 2022 with an average close of 6.3 months, but some take longer, right? So I would guess that 60+% of them are closed and or have done a first close, and the remainder are in process. So just to be clear on this for everybody here, you must complete a first close to be an alumni of VC Lab. So 100% will complete a first close, otherwise they're not an alumni. So the 174, we track every quarter, we track even more frequently. So all of them are on track, so to speak, are on a path to close. Just some have 60 some odd percent have closed and the rest will close. Do you want to read something and I'll take a sip, Niels?
Yep. We have a question from Amir. Amir is asking, everyone wants to do AI funds now. How are LPs differentiating between AI funds?
Sorry about that. I may have picked up a cough from my son. We're testing an AI fund of fund. Let me tell you. I'm looking at AI right now. I think last check, I think the data here is a little wrong. We have 18 AI funds that are about 5% of the total funds that we've created. Their total target AUM is just about 232 million. So they're larger than average because that's 5.75% of the AUM target. So they're a little, our AI funds are larger because as a number, the 18 are only 5%, but the AUM is 5.75%. So they're more, they're larger on average than the normal fund. We're seeing like good LP appetite for AI funds. Definitely. It's also not like they're a little bit skeptical because the issue is that AI valuations are very high. So we see LPs that are interested, but it's not like a shoo-in because they're going to ask a lot of questions, talk about your strategy, look at how you think about valuations, because the market's so hot that just you saying AI doesn't mean an LP is going to write a check, but it is one of the hottest sectors that we're looking at right now. So if you ask the next question, Niels, I will clear my throat. If you're asking questions in the chat, please don't. Ask questions in the Q&A, upvote the questions, and we'll get to them.
Next question is from Mark Phillips. With institutional investors choosing to not build new relationships, where can a second fundraising 50 million look for meaningful checks in the 3 to 5 million range?
Yeah, so Fund 2, you're still kind of a new manager. All right, so here's how the taxonomy works. Fund 1, you're 100% a new manager. New managers have a giant scarlet letter on their head. They cannot go to traditional institutional investors. Fund 2, you're entering emerging manager territory, but you're in that tween spot between new and emerging manager. And Fund 3, you are an emerging manager, okay? So In a fund two, because you're in a tween state, you can talk to a lot of the institutions, and a lot of them will waste your time because they're evaluating you for fund three. They're not actually going to invest in fund two, so it's generally not a good target. So your best target for $3 to $5 million checks are high net worth individuals and small family offices. Larger family offices will start to invest in fund two, but they require a lot of due diligence. So, I would pitch them sparingly. Like, you could easily spend 40 hours pitching a large family office, easily. And so if you pitch 10, that's like 400 hours. That's an enormous amount of time. Right? That's 10 weeks of time to pitch 10 large family offices that engage in proper due diligence, right? So but meanwhile, you get these high net worth individuals and small family offices, and they usually have a much less aggressive process. They'll make decisions sometimes after a meeting, and they can write checks of $1, $2, and $3 million. Maybe not up to 5, but certainly 1, 2, and 3. When you start getting up to 3 to 5, then you're moving into those larger family offices that will take the 40 hours of due diligence week per family office.
Do we have any geographic data and differences with regards to funds being raised in 2023? So anything related to source of capital, location of managers, focus of managers, and so on that we can
Yeah,
check?
so I just shared, or I didn't share a chart. So here is, I'll share this chart. Let me see if I can make it. I'm gonna make it a little larger. I didn't get nutty on the here, let's see. So I'm going to get rid of this. Let me share. Okay, so hopefully you guys can see this. This is sort of generalists are 19%, software 12, fintech 13%. So these are the percentages here and the sectors over here. It's not quite perfect because what we tried to do is put funds into a sector, even though sometimes they would say, I'm doing AI and deep tech. So we kind of had to pick one. So generally speaking, this data is not perfect because of that, but it gives you a representative sample. So, and obviously generalists are popular. This is about standard in the industry, about 20% are generalists, and then the rest are specialists. LPs don't like generalist funds, but to be precise, about 20% of LPs do like generalist funds. So 80% or so of of LPs don't like generalists. And so you see our data sort of matches what the LP demand there. Now you asked about regions. So again, North America, which includes Canada and Mexico, is pretty big. So I don't believe we counted Mexico in Latin America just because we put it in North America. So 36% of funds are in North America, 16% are in Europe, and 12% are in Africa, followed by Latin America, Asia, and MENA. Now, what I want to bring up is that this is our overall data, and Guy was asking about like more recent data in 2023. So the trends are like, we'll double the number of firms in Latin America this year. We've already tripled the number of firms on the continent of Africa. So we're seeing a lot of growth in the developing markets around the world. And in terms of choice of domicile, everyone's domiciling in the US. There's a couple reasons not to. If you're in Israel and you have Israeli LPs investing in Israeli companies, it makes more sense to go in Israel. Similarly, in Europe, if you're German and you have German LPs and you're investing in Germany, it makes sense to set up in Germany. And there are a couple places like Hong Kong and Singapore that you kind of have to set up in Hong Kong and Singapore if you're in Hong Kong and Singapore, because they make you set up there. That's how the law works. But outside of that, everyone's setting up in Delaware. There's also an exception for Canada. Canada, it's better if you're Canadian to set up in Canada. But literally, I just listed all the exceptions. Everywhere else in the world, Latin America, Europe, Africa, everywhere is setting up in Delaware. Let's keep rolling.
Sorry, I was on mute. Do you see in the near future a full AI to assist venture capital automation to reduce operating costs significantly?
Yeah, I mean, we have it, guys. It's amazing. I'll show it to you right now. So I'm gonna let me see. So this is the coolest thing. So we built an AI. Hopefully you guys can see it. And you can literally ask it anything, right? So you go up here, how do I do a capital call? Okay. So hit return, boom. Now, what happens here? So down here are what we've done is we've taken an LLM and we have set it on top of an expert system, an expert knowledge base where about 1,000 questions have been answered by professionals. So you can see the question that down here, like, what is a capital? A capital call is this, and different people answer it. You get votes. I like this one a little better, right? And then the LLM takes all of the professionally answered questions and churns out a report. So you could, what do I do with a delinquent LP, right? Now, interestingly, so it will answer, but like it won't answer things it doesn't know. So if you say, I don't know, like who is Taylor Swift, right? Yeah, no answer. But so it's smart enough to know what it doesn't know, and it will not give answers to things that it does not have source material for. So you know, and the source material is only this Q&A knowledge base that we've created. So back to the question, we have it. You get it for free. If you're in the VC Lab program, you get the software for free too. And it's changed the game, right? Because in the past, if you had a question, I don't know, like, you know, let me go back, I'll share it again. Like, not who is Taylor Swift, but like, let's say you were like, how often should I do capital calls? Of course, I type like very bad in case, so it probably can figure out the answer, but I'll just type it right. How often should I do capital calls, right? So this gives you an answer. Now, in the past, to get this type of answer, right, you might call your lawyer. And your lawyer will say, well, your LPA says this. And you're like, well, that doesn't give me an answer. That tells me what the LPA says. So then you would call your back office provider. And your back office provider would say, well, traditionally in the industry, you would do this. And those two calls alone would probably cost you about $2,000 at least, right? So the reality is like, but it's a kind of stupid, easy question, right? And so because we have this knowledge base that's answered these questions over and over again in different ways for different people, and then the large language model is able to interpret the question, and you can ask it combo questions that are like slightly legal, slightly strategic and even slightly accounting, and it will give you a unified answer. And these are answers that you couldn't get from your lawyer, you couldn't get it from your accountant, and you couldn't even get it from a strategy person, because you'd need all three in the same room at the same time. So this is game changing to the industry. Okay, game changing. Like, any manager can ask any question. And then, by the way, sorry to share the screen one last time. Sorry for the jankiness there. If it's not the good answer, you click this button and it makes the question, and then you submit it to the community, and then professional investors, professional accountants, professional lawyers all start answering the question, and that then becomes knowledge for the LLM to use in a future one. So it's pretty awesome. All right, let's keep rolling with questions here. If you got questions, get them in the Q&A. Remember to upvote them.
Yeah. Next question is from Matt Wilson. He is asking, with risk-free rates increasing, how do you manage LPs inquiring about fund hurdle rates?
Yeah, guys, hurdle rates are a no. You should just say, look, we're not doing hurdle rates are like, basically, you correct, Matt, what happens is, if let's say you have a $10 million fund, so in order to get into carry, you need to get to 10 million. Now, if you have a hurdle rate, in order to get into carry, it's 10 million plus the percentage of the hurdle rate. So let's say it's a 10% hurdle rate. So now you got to get to 11 million and you're in carry. But here's the thing, for you to be in carry isn't like you just get a percentage of the upside, normally set at 20% of carried is the carried interest percentage in most LPAs for new and emerging managers. So it's not like this is some amazing thing. It's you're just going to get 20% of every dollar over 10 million versus 20% of every dollar over 11 million. And so here's what I would say. I'm a new I'm an emerging manager. I'm not making a lot of money on management fees. So really, I make my living on carried interest. And like, you want me to get returns, right? So don't the hurdle rate just makes it harder for me to make money, which is like, you want me to want to make money. You want me to get amazing returns. Don't like hamper my ability to succeed with kind of crazy, complicated terms that aren't really that material, right? We're talking about like a tiny bit amount of money for an investor. It's like like, so, and let's take even a bigger step back, everyone. Venture is not a home run business, okay? Venture or venture is not a base hit business. Venture is a home run business, right? So hurdle rates matter when you're in the base hit world, right? Because if you get a single or a double or so let's make it material. And so if you're gonna only return, 1.1x your fund size, hurdle rates matter, right? Because that 0.1 is what you divide up. But everybody here should be shooting for 3, 5, 10x the fund size, because you're trying to get home runs. You're trying to get home runs in your portfolio, and you're trying to get home runs for your firm and your fund, okay? And that's 3x, that's 5x, that's 10x. And in that context, hurdle rates are irrelevant. All right, let's keep rolling.
I am being inquired about the distinctions between becoming an institutional investor with 250K or 2 million. Are there any exclusive benefits we offer for each tier, and how should we approach addressing this inquiry?
I'm being inquired. Niels, you got to read these questions. If they actually don't make sense, and no one is being inquired. So is someone asking you the distinction between institutional? Look, let's be super, so I'll take this as like, what's an institutional investor, okay? And what are the tiers of investment? So let's start with your minimum to invest in a fund is 100,000, period. No investor should ever come in at under 100,000. And frankly, you're kind of, you're going to have what you could call large LPs and small LPs. For the most part, $1 million commitment will be the break point. If you're at around 1 million, you're probably going to be a larger LP or above. And if you're 1 million or below, you're probably going to be in the smaller LP bucket, right? Now, are there some and then now let's look at who are these people in these larger LP buckets and smaller LP buckets. For the most part, at 1 million or less, you're dealing with high net worth individuals, and that's pretty much it, right? When you're at 1 million and above, you start getting into family offices, you start getting into corporates, you start getting into sovereign wealth funds, institutionals, and the like. And the reason they're at 1 million and above is because they usually have a lot of money to deploy. And for them to write a check of less than 1 million is just not even possible, right? Because they got to get so many people involved. They have to have lawyers and do investment committees. And when they, by the time they get all these people involved, to write a check under $1 million is kind of crazy for them, because they may have, let's say, 500 million to deploy into venture just this year. So what, they're going to write $500 million checks? No, they're going to do maybe 20 investments, something like that, maybe. So that's the way to think about this. Let's keep rolling.
Yeah, so this question from Paulo is actually related to this. He's asking, can you describe how investor archetypes change as you move from close 1 to close 2 and 3?
Maybe Niels, can you put the investor archetypes thing into the chat? We have a whole article on investor archetypes. So look, for fund 1, it's not going to change that much, right? You're mainly dealing with high net worth individuals and small family offices throughout. The amounts will change. So on your first close, you might only have 100,000 minimum. Your second close may be 250,000, and your third close you might raise the minimum to 500,000. So the people you go after, or the LP archetypes that you go after, will be the same, just the amounts that you require them to commit to come in will increase. You only start really changing your LP archetypes when you move to fund 2, and particularly to fund 3, when you open up the kimono to corporates, sovereign wealth funds, and the like.
Do we have a graph showing the number of VC firms on Dassault Hub over time and the time range of 2021 to 2023?
Yes, I do. I can pull that up. It's let me see, I'm in dashboard. So we have active firms by month, right? So I can share that. It's a little skinny because I don't want to share it. So you can see it's just, so what these peaks here, by the way, FY, and that's when we, peaks and troughs. So when we bring in a new cohort of VC Lab, everyone signs up, and then like there's like people drop out of VC Lab, they stop working on their funds, so then it goes down. Then new people drop out, go down. But what's been happening, what you're seeing up here is like, and this is July, by the way, so July is going up. What you're seeing is just like, we're not done with the month. So when we finish the month, it will go back up. Other questions?
Yeah, you may have a strong opinion on this one. Can VC ever be perceived to be as robust an investment option as, say, equities or bonds? If so, what needs to happen for this to become reality?
They're just different. Look, stocks are liquid. Bonds are also fairly liquid. Venture is just not liquid. Now, look, the asset class of venture capital is the #1 performing asset class for the last 3 to 5 years, depending on who you ask. Certainly, probably closer to 5 years now, because entering 2023. So the problem is, like, it's a long-term asset class, right? Your holding period's very long. So you invest and you're going to be 10 to 12 years. You start getting some exits, but the reality is that inside of 10 to 12 years, but it's a long-term asset class. With a stock or a bond, by comparison, it's an incredibly short-term asset class. You can get out almost instantly, in both. So, I think there's a lot of changes that need to happen to venture capital to make it as attractive an asset class as stocks and bonds, so liquid. And we're working on all this stuff. We're going to fix every problem with venture capital about liquidity, everything we're going to fix. We're going to turn it into a functioning, valuable asset class for the masses. And that's part of what we're doing. And we're going to make sure that it works on things that matter. So let me talk to you guys in a closing moment here. So we're at what I would consider to be a strategic inflection point for the entire venture capital industry. The industry has not really changed at all since it was created, depending on who you ask, in the 60s and 70s, right? I believe there was this Mr. Dorian, who was one of, the first venture capitalist, a Frenchman, actually, depending on who you ask. But sort of modern day venture capital kind of catalyzed in the 70s. And then, but if you go back to the 90s, when venture capital in what looks to almost exactly to today, it hasn't changed since the 90s. People are still emailing reports to people. They're doing diligence the same way. I mean, it is exactly the same as it was in the mid 90s. And it's time that 30 some odd years have gone by, or 30 years have gone by. It's time for change. It's time to modernize the industry. It's time to change who's doing the industry. More diversity, more global, more tools, and we're going to fix it all. And the most important thing that we're also going to fix as part of this is ensuring that the practitioners of venture capital are ethical and funding things that matter. Because the money that venture capitalists invest set the tone of the future. Because if they invest in a solar project or regenerative agriculture versus Instagram, that affects the lives of millions of people, in one case negatively and in other cases positively. And so far, for the most part, venture capitalists have been certainly not working on the betterment of humanity. For the most part, they've been funding things that have made humanity in a worse position. Okay? But we're going to fix that, right? We're going to help venture capital come back to being an ethical source of capital to fund things that matter and become a force for good in the world. And so I encourage everyone here, if you're interested in starting a venture capital firm, to join VC Lab Cohort 12. It's starting in August, and it will get most of you launched with a fund in 2023. Thank you, everyone. Have a great morning and afternoon.